I'm with Morten Nilsson, the CEO of British Telecom Pension Scheme, who have announced a wide-ranging climate change policy. Morten, great to see you today. Thanks for coming on.
Thank you.
This is really interesting development from one of the countries, from one of the UK's leading asset owners. And you speak of climate change as a clear and immediate risk to the scheme meeting its long-term funding obligations. Can you frame for us how serious this is, or quantify it somehow, the risk that you face?
I mean, if I start by just saying that the same day as we announced our net zero goal, we learned that it had been the hottest September globally, and that the ice was the Arctic ice was the second thinnest it's ever been, as long as it's been measured. And I think the fact is that climate change is there, and it's there's enough evidence to show that the Earth is warming, and we have more and more weather phenomena that are hitting us, and that's just there. And I think for us, when we look at it as an investor, we can look at it from many different ways. But if we say there are some physical risks to our assets, we can see that a company, an investment grade company, US company like Pacific Gas and Electric, has gone bust due to exposures to wildfires. And that's one real physical asset, an investment grade company, as I said, that's going bust due to this. We see there are transition risks, and that transition is coming from many different routes, but one of them being regulatory, and where we can see that, for example, industrial companies in Europe are facing more environmental regulation than in emerging markets, which drives up the cost for those companies. So I think the way we are looking at it is there are clear, visible impacts today, and of course you can argue with all of this. How as in your question, how do you quantify that? And it is quite difficult to quantify, and it's quite difficult to. You can argue. Some people might argue that this is further away than we are arguing, but I would also say that with a portfolio our size, we can't change day to day. It takes time to change and time to make sure we're positioned in the right way. Which means that we do need to take this quite serious and take that serious now. And I think we've been trying to measure it in different ways and trying to quantify it. And we've been doing this Mercer study 3 times now. We did it in 2011, we did it in 15, and we did it in 19, where Mercer was helping us run through different climate change scenarios and run that through our portfolio and see what's the impact on that from that. And one part of it was positive for us in that we were, compared to many of our peers, we had less risk than we might otherwise have had, and that's due to it having been quite a core part of our discussion for a number of years. But I think it was also highlighting there were more we could do, and there are areas where we could be concerned. And of course, whether for a scheme our size, we have a number of different risks. But I think the climate change risk, the thing that I feel and we feel is quite difficult in that is that it is such a complex change, and it's quite hard to look ahead and see how that impact will be. But I think for me, when I look at the scenarios we're looking into, it's either negative or extremely negative. And what I've seen so far, and what I think the scientists have showed us so far, that quite a lot of the change has come faster than we expected. So, for instance, the ice cap is melting faster than scientists expected a few years ago. So I think it's only prudent of us to regard this as a significant risk and take appropriate action.
You talk about the work with Mercer. Just wondering how you arrived at this point. What Did you take advice from the scheme actuary, from the investment consultant? Did you take legal advice around this? What went into the decision?
I mean, it's probably worth starting out and saying that the scheme has been considering climate risk for the last 13 years. So it's not a new thing, and we set up a working group, a responsible investment working group, about 12 months ago, where we worked across the entire investment team to put more momentum behind this, because we felt we needed to do more. So it's been quite a considered effort, and we've actually been following the TCFD recommendation for the last 3 years in our annual accounts, and we have seen that we've made good progress. 40% of our equities are 40% below the indices we follow, and corporate bonds 60% below. So we've seen progress. But to answer your question, we are BTPSM is a fiduciary manager and the primary investment advisor to the scheme. So it was managed internally, but it was managed with a lot of input from Mercer, a lot of internal data analysis and carbon footprinting analysis, and help from externals also on that. And then we were engaging with all our fund managers to see how did they see this, what would be the impact for them, what were their learnings. We were talking to industry people, we were talking to our sponsor BT, of course, also, and getting their thoughts and views on this. And we were also talking to scheme actuaries. So it was quite a broad number of people. We were also actually interviewing our members, which we thought was quite an important part of it. So we surveyed our members, and 8,500 members answered that survey, and 74% said that they thought the scheme should consider environmental and social aspects when they were investing. So we were very thorough on this. And arrived at it, but it clearly has been quite a difficult decision, and part of the difficulty here is, as I touched on a little bit before, there's quite a lot of uncertainty when you look ahead of what the scenarios would look like, and there's an uncertainty in where we are starting from.
Strikes me this is trustees taking their fiduciary duty seriously. I mean, has some of the debate around fiduciary duty that's been taking place, has that fed into this, and some of the regulatory noises from that are out there, has that fed into this decision?
I mean, I think it always does, and it always impacts the decision process in one way or another. I think the primary fiduciary duty for the trustee is that we can deliver on our promises to our members, and that's at the center of everything we do, and that's a starting point. I think the way we've been coming at this, and the way we've been thinking about this about climate change, has been from an investment perspective. So we've very much taken an investment approach to it and thought about how do we protect our assets going forward? How do we protect our performance? How do we ensure that we get the right performance for the scheme, and we are placed as well as possible to get that performance? And we've seen this exercise very much as a risk management exercise, which is what we do all the time, and where a lot of what we're trying to do across the scheme is to narrow the outcomes and the range of outcomes, so we can have more stability and more precision in that, and that's why we've been hedging our interest rate exposures and inflation exposure, and we have some equity hedges on also, but this is also seen as a way of managing what we believe is a major risk.
You say this is a unique opportunity as your members retire and the fund reinvests into more secure assets. Can you expand on that a little bit? That the opportunity that you feel you have.
Yeah, and I think we've when we've been analyzing this shift a few years ago, we decided on a move towards this cash flow aware portfolio, where we are very much focusing on on a portfolio that can help match the cash flows we have for our members and paying their retirements. And that shift means that over the next 15 years, we will be reinvesting the majority, a large majority actually, of our assets. Some of them will be corporate bonds that will just mature naturally, and some of them will need to be reinvested to help provide that income. So that gives us quite a unique opportunity where the transition costs are or transaction costs are very low, and it gives us also a point in time where we are thinking, if we waste this opportunity, we won't get this opportunity again. It's quite a unique opportunity for us where we have such a chance of shifting our portfolio in a cost efficient way, and where we need to do it anyway. So now is a good time to think about how can we do this, and both protect the scheme from the most likely outcomes of climate change and all the regulations and all that coming through from climate change, but of course also take advantage of the opportunities that we think will come out of this transition.
Do the assets exist out there for you at scale?
It's an interesting question, because I think one of the things we've been discussing quite a bit with our investment managers have been that that of course we live in the real economy and in the real world, and we have 55 billion of assets we need to place somewhere, and we need to make sure that they are giving us the returns we need to have. But what we're quite clear about and quite convinced about is that the investment universe is big enough for us. And I think it's worth in that, considering that there are quite a large number of low carbon emission companies you can invest in. But also, which is a very fundamental part of our policy, is that we are more than happy to be part of a transitioning towards a low carbon business model. So we're not excluding high carbon emitters. We are, on the contrary, saying if they have commitments to reduce their emissions, and that we can find ways to hold management to account for that transition, then we will support that. And we believe that from an investment perspective will give us much better opportunities to place our investments. But we also believe that actually from an environmental perspective, that's maybe where the biggest gains for the planet will come from. So we're quite keen on that. And perhaps thirdly, I could mention, I think green bonds and other things like that are coming in, and we think over the coming years there'll be much more of it, and it will be and similar instruments to that, and they will likely also be better controlled and better monitored and easier to invest in.
So the scheme is 88% funded. And a time of increasing uncertainty, you don't need to say what they are, COVID and Brexit and everything else. Is now the right time to be making these kind of decisions?
I mean, I think no doubt for us it is the right time, because we see this, as I mentioned, is a big risk. It's a risk that we are actively managing, and a risk we think needs to be actively managed. Also think, I mean, I think it's an interesting question, because I think for me there are many risks, and it feels like globally also that there are more risks and they're more fundamental now than perhaps they've ever been. And of course you could choose that as an excuse to say, let's do that tomorrow when we know a little bit more than do it today. But I think our main role is to manage the risk for the scheme. And that means that we need to manage these risks, and climate change is one of them, and one of the big ones. And I also think that it's worth saying that we don't believe, as I've said before, we don't believe we're sacrificing performance from this. We believe that this will give us at least the same performance, and likely a better performance than we would otherwise have. So we are seeing as in its own right, as an investment decision, it's the right one to make. But if I may, just one last thing on this coal thing, because I think there's one other thing which for me is quite interesting, is that I think somehow we will see a polarization here, both from countries and companies, that some companies in some countries will say, because of COVID, we can't afford to be good corporate citizens, or we can't afford to transition to a greener economy or to a more socially aware economy. And other countries and companies will take the exact opposite and say this is an opportunity for greener recovery, as the UK is saying, as the EU is saying, and a lot of companies I think will also feel more compelled to be good corporate citizens because they can see that they've been supported through COVID by governments, and it could have very, very negative impact on them if they are not supporting that, and therefore they can unlock capital that might be cheaper, that might be more available from investors like us if they are having these plans. And but I do think we'll see a little bit of polarization here.
Does the fund feel it has a leadership role? Amongst the institutional investors? I mean, I've found drafting signatory of the PRI and so on, sort of a leading fund. Is that part of this?
I mean, I think our primary responsibility is to our members, and that's the first, and that's where it starts. I do think, as you said, we have a DNA in the scheme where we have been heavily involved in responsible investments for a very long time. And see that as part of our natural way of thinking about investments. So that has been part of it. And of course, being a large scheme, it does mean that that in one sense what we do will be taken notice of, which does give a bit of responsibility, I think. But I also think that we also have because of the scale of investments, or scale of our assets and the way we invest, where we like to concentrate our mandates quite a bit. It also gives us more influence to get the mandates designed as we would like, and it gives us more influence with governments and others. But all of that being said, we can't do this alone, and we're very clear about that. And for example, when we have 55 billion of assets, and yes, that's a lot of money, but when we join the Net Zero Asset Owner Alliance, there we have, I think, 5 trillion pounds of assets. That's a completely different power we can draw on there. And we do believe that we need to come together and push for this change and use that power.
You talked about your concentrated mandates. I'm really interested to see how your asset managers have responded to this. You've got some blue chip names on the roster, sort of BlackRock and PIMCO, Wellington, people like that. What's been their response?
I mean, they've been very positive and very supportive of this change, and we have had, as I mentioned earlier, I mean, we've had quite in-depth dialogue with them, because we of course also rely on them being able to deliver for us against this. And I think, in a way, perhaps the first point to make, which is important, that we have quite a concentrated view on this. So I think we have about 20 investment managers across the portfolio. So we don't have hundreds of investment managers, and that gives us more ability to engage and go and have more in-depth engagement with our managers. It of course also means that the size of the mandates is bigger, and therefore gives us more influence. But they have been very supportive, and I think, in a way, I think they are also probably also seeing this as an opportunity for them, where they can see the trend, and they can see if one of their large clients is pushing for this, they can probably use that elsewhere. But perhaps the other thing I probably should have mentioned before is one of the things that influenced us a bit was that we looked at some of these very commercial organizations and realized how important a risk they saw climate change, and how they saw this as something that needed to be acted upon. So it wasn't, that was quite an eye-opener for us in seeing, that their reaction over the last few years. So a very long answer to your question. We have seen that they have been very supportive, all of them.
Are you going to be redrafting the investment management agreements with the fund managers?
Yes, we will do that. So we will update it with this new policy and make the goals very clear. And we need to we're working on our voting policies, for example, also because we want to further strengthen that.
Yeah. So active ownership is part of this. What does that mean? Does that mean the kind of forceful stewardship idea, filing shareholder resolutions? We're going to see more of that from BTPS.
I mean, a lot of this is managed via our managers, so it's indirect for us. But we believe stewardship is a very key part of the policy, and it's one of the four pillars we've outlined, driving the policy forward for us. So it's very key to us. And again, I think it's key because we think there's a lot of opportunity in companies that are transitioning towards a lower carbon business model, and we want to be part of that. And we think that's an investment opportunity. We think it's an environmental opportunity as well. So we need to see that come through from our managers, and that they are actively voting on our behalf and actually engaging with companies on that transition and holding management to account. It of course also means that we have expectations for the managers in this, and that we need to work with partners that are also articulating clear intent on carbon emissions and climate change, which is the other side of it.
So what does the portfolio start to look like going forward? If you fast forward 5 years, where is BTPS portfolio? Very interested to see what your view of how it could evolve.
I mean, we're seeing that there are we're seeing that there are opportunities in investing in. I mean, we have a large investment already in Fallago Rig, a wind farm in Scotland, and we are seeing there will be investments like that. That will be form part of an increasing part of the portfolio, where we will see investments that are supporting that low carbon economy going forward. We also think there'll be a big opportunity, as I've mentioned a few times, on these transitioning companies, and in a way, I think that from an investment perspective, that might be where the biggest opportunity is going forward. Because some of those might be priced more attractively than other assets, but we are moving towards, as you mentioned earlier, our members are retiring, and 15 years from now, practically all our members will have retired, and at that point, we will need to have income-producing assets that can match that. So we see that could be. We've made some interesting investments in affordable housing, which have paid off well, which again have had a good climate policy around it. So real estate will definitely also form part of this, and again there's quite a big climate side to that. So it will be a number of different assets, but mainly focus on creating income and supporting this climate goal.
I notice you're not talking about climate tilting or underweighting or any of that sort of language.
No, and we're not following benchmarks, so we're not measuring our performance against relative to any benchmarks. We're looking at an outcome-based approach, which does give us more freedom here, and has also allowed us to have a slightly longer term perspective on our investments. And perhaps relevant to say here is that part of the process we've gone through over the last 12 months has meant that we've changed our overarching investment principle, which used to be finance first, and now it's creating long-term sustainable value. And we think that's a sweet spot for us, and in many ways has been where we've been for a long time, and where we've seen that. I mentioned our carbon emission earlier from our equity and corporate bond portfolio, and we've seen that shift towards that due to having that long-term perspective, and we think that's the right thing for the scheme.
So do Do you see yourself as a partner of transition companies? I'm thinking of BP and the Shells and the fossil fuel majors. Do you see yourself working almost in partnership in a sense with these guys?
Yeah, we can see that. I mean, we can see where we have, and there's also in our current portfolio, we can see we have a handful of investments that in our equity portfolio that are responsible for a very large proportion of our emissions. But those companies have quite aggressive transition plans, and as long as they have that and are actually delivering against them, then we would be happy to be a partner in that transition. And we do think there could be some quite substantial investment opportunities in that. And I think it's again for us, I think we need to be practical about how we're doing this and be quite focused on this is a real change in the economy, and we still need fossil fuel, and we will need it for some time on. And if these large companies are committed and transitioning and doing that at pace and with proper intent, then that will have a bigger impact for our society than if we just hand those shares off to someone who has no intention of anything else but making a quick buck on those investments.
Yeah, I'm just wondering if the tools are out there to achieve what you're looking for. I'm thinking we mentioned indices, but carbon footprint analysis, scenario analysis. We're kind of at the start of all that. I mean, does the industry have to develop first?
I mean, we are, and it's a good point, and I think it's one that makes a decision like the one we took more difficult, because it's right that we don't have the data we would like to have, and we don't have the tools we'd like to have. What we can see is that the data and the tools have evolved quite significantly over the last few years, and we are convinced that they will evolve quite. I mean, if we have a conversation in 5 years' time where we're looking back at this, I am convinced that we will have seen that tools have developed significantly and fast, and data has improved significantly from where we are. We see regulations coming through. We saw the International Accounting Standards Board came out again last week, talked about what they were planning on doing. So I think there's no doubt in my mind this will be better. But I also think it's been a challenge in our decision, as I said, and I think personally we will never have the perfect tools and the perfect data here, because you never have. But that shouldn't be an excuse not to do what's right to do. And you know, again, you can wait forever for these things and not do anything instead of just getting moving. And we do know that, and we can measure carbon, but we just can't measure it as well as we would like to. So we can see progress and measure progress, but we'd like to know more and have better tools, as you say. And I think, sorry, if I made the last thing on this, again, our announcement gives us a new way of communicating this with both the investment managers we work with internally, to our colleagues and to governments and other stakeholders, and that engagement is quite important. And I think and if we can team up with other peers and other industry groups and other interested parties, I think we will have enough power to make significant changes here and make rating agencies, for example, also become much better on the way they use these parts in their ratings of companies.
I think I'll draw it to a close there, Morten. Thank you so much for your time. It's really interesting having this debate with you. Thank you so much.
Thank you.